Good morning and welcome to Finance and Money Matters, episode 8, Friday, the 8th of August. It's not been a particularly news-heavy week, and so I think it's been a really good opportunity to make some observations about the markets and about what we're thinking around the investment process. We did have results, and we'll talk about those a little bit, from Caterpillar, Diageo, some commentary from Apple when Tim Cook, the CEO, met with President Trump, and most recently some results from Eli Lilly, which resulted in the stock falling 14%. We've also had an interest rate cut in the UK by the Bank of England, and we'll talk a little bit about what that implies. And thought for the day is really around the side effect of the tariffs, the big beautiful bill, and the likely reductions in interest rates in the US, and in a socioeconomic terms, who that might affect more than others. And we'll look into the issues around the impact, the side effects of tariffs when they apply to heavy or capital intensive businesses versus asset light businesses. So let's start with the big picture. The UK interest rates have come down by 25 basis points to 4%. The Bank of England is wary, and they're right to be. The analyst community is thinking that there's potentially another relatively small interest rate cut before the year end. I'm not so convinced. I think that the UK is in a fiscal bind. Not only are there going to be some significant tax implications coming up in the autumn when Reeve comes up with assumptions on how to try and balance these fiscal problems, one major answer is going to be to issue more bonds. And if you're going to do that, you have to do that in an attractive interest rate so that investors, both domestic and foreign, will be enticed to buy those bonds to effectively fund the UK deficit. But in order to do that, particularly clearly from an international perspective, your currency has to be strong. And in this case, it can only be strong if interest rates are sufficiently high and inflation is sufficiently low to allow for real interest rates to offer you an adequate yield. So therefore, I genuinely believe that the Bank of England's hands are tied, that any interest rate reductions are unlikely to come flying through over the next 12 to 18 months. That is not particularly positive for homeowners. It's not particularly positive for UK corporates. And this tepid growth is likely to continue in UK. Let's move to some of the results and some observations about those results. Caterpillar, clearly a very capital intensive business supplying the construction, mining industries, infrastructure, announced a set of results that contained, interestingly enough, a $1.5 billion charge for future tariff costs. And we kind of started to look at that. And just this week alone, Diageo also talked about a increase in their case of some $200 million for potential tariff costs. They have other issues. Their sales are falling. I think there is a cultural shift. Gen Z is moving further away from hard liquor and brown spirits. I think that there's certainly an element of the GLP-1, that is the obesity drug, playing a role in this, of reducing revenues at Diageo. But those aside, it's interesting to come back to this tariff charge issue. Another supporting factor has been Tim Cook's offer of $100 billion worth of investment into the US, building glass for the iPhones. And again, that is very much an attempt to disarm Trump from further tariff charges on Apple. $100 billion is clearly a small amount of money in Apple's perspective compared to the potential tariff charge that would come through. And that kind of set us thinking in terms of, what does this mean from the perspective of those capital intensive businesses versus asset light businesses like the technology sector? Well, it just creates a further divergence in the opportunity, because if we think about it, the US runs a near global surplus in non-tangible, non-trade business or flows of business in the world. And that means that like Netflix subscriptions, meta advertising costs from foreigners who are buying, all of those, the US runs a surplus. Well, in that case, that means that those companies like Meta, like Google, like Microsoft, who are selling their services worldwide, don't face any kind of tariff. And so this is where the divergence will likely come through even more as we go forward. That is going to be reflected in margins in those technology businesses. And that's going to also reflect negatively in margins for those capital intensive businesses. So this kind of broad recovery that market analysts talk about, I don't think is really on the cards. I think the concentration of the profit opportunity continues to reside more so in technology and US technology specifically at the cost of those companies that make things and are therefore subject to tariffs. Let's turn to Eli Lilly. The stock is down 14%. They announced that their pill form of their GLP-1 obesity treatment is running at an efficacy rate of 11% versus their injectable, which is at 25%, and Novo Nordisk, Wegovy, and Ozempic at around 15 to 16%. The side effects are pretty much the same in terms of the study that they've had with over 3,000 people. And so the market decided that the $20 billion potential of further revenues that would come in from the pill form are likely to be lost. My view here is that Eli Lilly is more to do with the fact that their success is going to be their ruin to some extent. There are some studies have suggested there are 12% of the US population have at some point tried the obesity drugs, both of Wegovy and Jaro and Ozempic, and that currently some 6% of the US population is on the medication. More than 1.5 million people in the UK are on the medication. And what I think governments are seeing here is an opportunity to cut serious cost from their healthcare budgets, because most of those healthcare issues and costs come from cardiovascular issues, cancer issues, obesity related. And so if we have this wonder drug that can reduce the effects of those, there'll be a significant cost saving in healthcare systems. And so governments are putting tremendous pressure on these producers to reduce or cap prices significantly. And certainly we've seen that with Trump's campaign against the drug producers. And I think that is where we should concentrate our attention. So let's move on to thought for the day. The middle classes, particularly in the US, have been hollowed out over the last 20 to 30 years, thanks largely to tax, thanks largely to earnings of skilled people falling behind the rate of inflation growth, particularly post-COVID. But what we've seen and what we could potentially see over the coming administration's time in office is an interesting combination when you put the big, beautiful bill, the likely reduction in interest rates, and the tariff implications into play. I think we're beginning to see a resurgence in the middle classes in the US, which is a good thing, and potentially a decline in the buying power of the working classes, the very same core that got Trump's administration into power. And what do I mean by that? Well, we are seeing that the middle classes are probably some of the biggest beneficiaries of the tax bill that's coming through. They spend more on services than on product, which means less of an impact from the tariff. The effect of the non-discretionary purchases, i.e. groceries and food, is smaller on the middle class purse than it is on the working class purse. And so again, the tariff implications are less for those middle class buyers. Their 401ks, i.e. their pension schemes, are doing well because A reduction in interest rates, deregulation implies better stock markets, so good for pension funds, and those are owned more by the middle classes than the working classes. Lower interest rates imply higher property prices, lower mortgage costs, which again is in the domain of the middle class versus the more rented environment in the working class community. And of course, AI and automation is replacing jobs both in terms of both working and middle classes, but more likely the first impact of that is on the more unskilled parts of the labor market. So Trump's very own base could actually turn out to be the biggest losers in this administration's policies, thanks to a combination of the big, beautiful bill, the tariff regime, and the interest rate declines. And it's potentially excellent for the middle classes who are resurging. And in terms of general productivity and economic growth, that's actually a positive sign for an economy when the middle classes can begin to do well. And I think, therefore, that's yet another supporting factor for investing and over-investing in the US versus other regions. Next week, we're going to have some CPI numbers in the US, which I think are important because that's going to drive the Fed's next moves as far as interest rates. But certainly, we should expect at least another 25 basis points of reduction in the US between now and year end, if not more. Anyhow, that's enough from me. Have a wonderful, peaceful weekend with your families, and we'll speak next week.